Saying the Fed said this or the Fed said that is common lingo the past couple of years, but exactly who is the Fed and how does it work? Hi, I'm Jeff with the Jeff York team, and I'd like to break it down for you. The Fed is short for the Federal Reserve, which is another phrase to describe the U.S. central banking system. Their objective is to keep a healthy U.S. economy and maintain stability within our financial markets. The Fed has what they call their dual mandate. Their ultimate job above anything else is to promote maximum employment and stable prices, which translates to 2% inflation. The Fed is made up of the Board of Governors, the 12 Federal Reserve Banks, and the Federal Open Market Committee. The Federal Reserve Board of Governors is made up of 7 members that are nominated by the President and confirmed by the Senate. They can serve up to a 14-year term, and if they serve a full term, they cannot be reappointed. The President, Vice President, and Vice Chair for Supervision serve 4-year terms and are nominated by the President and confirmed by the Senate. Basically, each president can put his people in at some point during their presidency. The current chairman is Jerome Powell, who was reappointed in May of 2022. The Board of Governors makes an annual report to the Speaker of the House. They regulate operations of the 12 Federal Reserve Banks. They're funded by fees assessed against the Federal Reserve Banks and are not part of the federal budget. The Fed and the mortgage market move like dance partners. Sometimes the Fed leads, sometimes the mortgage market leads, and sometimes they dance on their own. The federal funds rate and mortgage rates usually move in the same direction, but it's sometimes hard to say whether mortgage rates follow the Fed's actions or the other way around. So, what causes mortgage rates to change? One word: expectations. When everyone starts to think the Fed won't raise their interest as quickly or aggressively as they previously expected, interest rates go down. The Fed influences mortgage rates by changing how Wall Street views the future. The bottom line, the Fed aims to maintain economic stability, and the tools that it uses affect bank lending rates. When the Fed wants to boost the economy, it typically becomes less expensive to take out a mortgage. Conversely, when the Fed needs to slow inflation, it acts to drain liquidity from the financial system, which typically results in a higher interest rate on mortgages. If you have any questions about the Fed, mortgage rates and programs, or anything else real estate related, please reach out to my team and me. And remember, when you do what you love, people love what you do.